Thank you very much. Good morning, everyone. Hopefully you've had a good few days so far. It's a pleasure to be here, and certainly a pleasure to moderate this esteemed panel on a topic that I think is quite on top of everybody's minds right now, which is what do we do in this uncertain world with respect to asset allocation. Certainly, I have to say from where we all sit, we are living in unprecedented times. I don't think, at least in my lifetime, I've seen that many dislocations, that many issues that we are all grappling with as a globe, all hitting us at the same time. So we have elections in 65 countries this year, constituting 58% of the world's population and 60% of the world's GDP. That's quite meaningful, it's a mouthful. The US alone, I think it'll be quite interesting to see how those elections go, and quite polarizing by any stretch. We have geopolitical issues and uncertainties. We have a war in Europe. We haven't seen that in a long, long time. Russia, Ukraine. We have a war in the Middle East between Israel and Hamas. We have the Houthis that are taking a little bit of a challenge across the trade flows between the Red Sea. So that generates quite a lot of uncertainty in that, as far as that's concerned. And we've gone from an era of globalization and trade partnerships to potentially an era of deglobalization, localization, and trade wars. We've seen that between the US and China. We can see that in some other sort of formats as well. The world is going towards localizing production. What that means is that inevitably we're going to live in longer years of inflationary environment, because costs of goods are going to be higher as a result of all of that. And then with all of this as a backdrop, we're finding leaps and bounds in technological growth, technological developments, generative AI taking us in a different direction. And that we haven't even begun to talk about global warming, and we haven't even begun to talk about ESG, which now is so lower down the list than it used to be historically, given everything else that we're seeing. With that as a backdrop, it's really a pleasure to be here and a privilege to be with the esteemed panelists that we have, and I think we're going to have a really interesting debate on these topics and trying to get a little bit more clarity and direction in terms of where people think. Bob, if I may start with you. You are a co-CIO of Bridgewater, which manages over $125 billion of assets under management. You've been in that firm for over 38 years. Not that I should, maybe necessarily age that, but you've been there for almost a lifetime. And in this world of uncertainty, how do you look at portfolio asset management? How do you look at where do you drive decision-making so that you can continue to perform in light of everything that we're hearing?
Well, thank you. Yeah, you've outlined quite a number of challenges that we and everybody else face, and I would add more to that list. But I think it starts off with having a certain framework for understanding how economies work, how markets work, how they relate to one another, and then how to translate that into structuring a portfolio or an active trading strategy. And when you apply that to today's world, you see quite a difference between different parts of the planet in terms of their, in particular, the attractiveness of assets relative to cash. One of the frameworks that we start with is, for a given economy or currency, do you want to hold assets? Do you want to hold cash? And most people don't realize that in the last 2 years in the U.S. economy, T-bills have been the best performing asset, even with the NASDAQ way up, because it went way down before that, right? So, but you're in an environment of a tight money policy because of inflation, and the inflation is due to an overstimulation of the economy after COVID. And so you have that situation in the United States and in Europe, but in Asia you have the exact opposite, and largely as a result of the policies to deal with COVID, which were more social and actually produce weak economies. So whereas you have inflation in the United States, Europe, UK, you have deflation in China, for example. And then when you have Japan, you actually have a relative stability in Japan at the same time as they're producing some governance changes that are actually encouraging to investment there, and it's a political safe haven. So you have these very different conditions all around the world, and I think that the starting point to answer your question is to recognize the potential for not only return enhancement, but for managing risk by diversifying around the world, taking advantage of global diversification, which is something for a couple of decades was not worth much, because global capital flows produce such high correlations across the world that it really people just forgot about global diversification as an important thing. It's never been more important than it is now, because you have diametrically opposed economic conditions around the world. And then as I go one step further to how we apply that, the generalized principle that we try to apply for our portfolios and for our clients is this idea of minimizing environmental bias. Environmental bias is any sort of an exogenous influence on your returns. It could be growth, inflation, tight money, liquidity, whatever. And trying to design strategies that minimize those kind of environmental biases, because it's the ebbs and flows of a particular environment that actually cause the variability in returns over time. And so building tools and methods and strategies for doing that is really kind of our path.
Thank you for that. Marlene, if I can turn over to you. You manage over $160 billion on behalf of the state of Alberta, and you have a mixed portfolio of public, private, infrastructure, et cetera. How do you fare in this environment? What are you doing?
Yeah, it's a bit of a challenge, and Bob, you've done a great job talking about that regional and global environment, and I think you're absolutely right that the global diversification is now actually playing a more important role than it has in the past, and we have to really think hard about the geopolitical environments in ways that we haven't really had to previously as well. For us, we manage for 15 different clients, and we manage pension assets and endowment assets. So each of our clients has a bit of a different goal in mind. So we have to keep that as at the center of our thinking, and at the same time, deliver for them against their long-term strategic asset mix. We execute against that long-term mix. So in terms of deciding what that long-term mix looks like in this environment, our clients are really thinking more and more about their liabilities, those long-term liabilities, and with interest rates still being relatively high, and they're going to come down, but they're still on the higher side than they've been for the last decade or more. There's an environment where they can actually put more into those conservative assets. You know, as you say, T-bills have been great, but the longer-term bond yields are still, they're more attractive today than they've been in quite a while. Credit is an asset class that has more diversification in it than it has historically. We used to be able to just invest, you know, primarily in the public bond market or leveraged loans. We now have a whole much more complex set of environments in the private debt markets. So the fixed income space is more interesting than it's been in a long time. Yeah. So we're putting more into those areas because it matches against those long-term liabilities, and it's conservative, and it protects against that, you know, long-term need. But we still need return-seeking assets. So what are we looking at in that space? Well, I'll talk about a few pockets of opportunity that we see that we think are good spots today. Private debt I've already mentioned, and we seem to be able to really ride the private debt market through the cycles with careful credit selection. Real estate's taken a significant hit of late, certain pockets related to COVID and so forth, but we're really putting money to work, primarily North America and Europe, in real estate in more pocket areas. Multifamily as a specific asset class, as an example, grocery-anchored retail. These are kinds of areas that are resilient to the uncertain environment. So we like those kinds of things. And then, broadly speaking, really just diversifying across our private asset classes and thinking about where do we as an asset manager have any form of edge, or how do we develop that edge? And one way that we do that is working with strategic partners across the world. And that boots on the ground knowledge of the local markets, as we, you know, here in this region, for example, is really important. So we work with strategic partners and learn from them, and then, you know, take opportunities in co-investment to be able to take advantage of their local expertise. And we've just opened offices, for example, in Singapore and in New York that are anchoring our strategies in those two areas. So with Singapore, for example, that's a great gateway into Asia, and that's part of our overall strategy, is increasing our diversification regionally there with, you know, you mentioned Japan as being a particular area of focus, India, for example, and our focus there is primarily in the infrastructure space and will be more in private equity.
Great. Thank you. Steve, if I can turn over to you. You manage a private equity portfolio on behalf of the Social Security Fund of the state of Kuwait. And your focus is more on the private equity specifically. again, in this environment, are you disadvantaged or advantaged in looking at longer-term private equity investments when we are living in a bit of an uncertain world with a lot of volatility in it?
Well, thanks, May, for doing this, and thanks for having me. It's true, I have a bias in favor of private markets. This is a little bit self-serving, or maybe I just ended up in private markets because I believe they're intrinsically better, more valuable, more broadly applicable than public markets. Of course, there's a cost connected with that, which is liquidity. But if the question is, how do you manage the colossal and increasing degree of uncertainty in the world out there, I think that private markets offer some fundamental advantages. It may, in fact, be a better form of governance, but importantly, since the first and the best way to deal with the things that you don't know are coming, that is, the best way to deal with uncertainty is diversification. And I heard, Bob, you referred to diversification geographically, among other variables, and the variability in the credit markets. A different way to think about diversification is that sort of tactical choice about between public and private equity, to the extent that's part of your landscape. The reason I think there's embedded diversification there is maybe obvious, which is to say that there's a large part of the economy of the planet that you don't touch through public markets. You don't touch directly. I mean, in the U.S. markets, for example, which are the markets I'm, most familiar to me, you've got maybe 4,000 to 5,000 public companies, that is listed equities, left. It was about 8,000 20 years ago, but you have 4,000 or 5,000 now. There are 4 or 5 million private companies in the U.S. alone, and I'm not including all the little LLCs that probably everybody in this room has in their back pockets. I mean, genuine companies with a number of employees. There are millions of these companies. Now, a better way to think about that might be market value versus number, but and the ratio would be different. But still, there are many more. The broad balance is in favor of the private companies. And those private companies have some attributes that large public companies don't. And here I'm generalizing, but it's my view that innovation occurs among these smaller companies, not among the biggest companies. Elon Musk would disagree with me on that, but there is a lot that we can see and do on behalf of our parent, which is the Social Security system of Kuwait. There's a lot that we can see and do by backing venture managers and investing alongside them in areas like biotech, in areas like AI. And innovation is fun, it's important, and I think you get there through private markets. So I could carry on there, sort of singing my song about private markets, but that's how that's one mechanism for addressing all the uncertainty that's coming our way.
Great, thank you. Eric, I'll turn over to you. You're sit more on our, you and I on the same side of an aisle, so to speak, as advisors rather than investors. And you come from a very interesting background in government and policy making as well as advisory. In this environment, what do you advise your clients to do? Do you tell them to hold off, don't do anything, wait and see? Or do you say, okay, take advantage of uncertainties and go in for opportunities? I'd be really curious to hear your perspective.
Well, May, I think as advisors, we want to be there with our clients, sitting alongside them, not always telling them to go ahead, pull the trigger, let's go. But I do think that the title of this discussion is so apt because we are in really just such an uncertain world with geopolitics, frankly, being on the top of the agenda in almost every meeting that I'm in. And, it's interesting to hear Bob talk about sort of trying to remove the external or environmental bias and these exogenous influences that could impact a decision. But, when I think about what's going on in the U.S. right now, there is a huge sort of magnet that's pulling in investment, and that's this industrial policy that's taken the form of the IRA. And that bill, in terms of hundreds of billions of dollars, and totally it was $1 trillion measure, but it is a significant incentive for investors to say, it just makes a lot of sense for us to go to the U.S. And I know it's causing pains in Europe, causing a lot of discussion with clients that we have across the world. Hey, should we? go there. But then when that decision is made, you peel back another layer, and another geopolitical concern is, well, wait a minute, as a company or an investor, I'm not sure I want to get in the middle between this sort of U.S.-China trade war that is boiling, if you will. I think our administration is trying to keep that at a low boil right now. Which, you know, sort of brings you back to here and where we sit in the UAE and the Gulf. And it's such an interesting and successful model that has been undertaken here in this country, where you have leadership that is so committed to open the door for investment and essentially position the country in the middle and say, we don't want a part of this geopolitical discussion. We just want to provide an environment where people can come and seek return and make money. And ultimately what that does is to benefit the population here in the UAE. They've done an extraordinary job, and I think it's trying to remove some of that uncertainty that you titled the talk about, and together with, again, the confidence that I think investors have, because I know we at Moelis, we've been here in the UAE, I think, over 15 years. We're very proud to have been part of sort of the transformation. We had the privilege of working with His Excellency Dr. Sultan in some of the first sort of transactions where some of the large asset managers said, hey, we'll take a look at this country, this geography as an inbound place to put and deploy our capital, not just to come here, take the capital and deploy it elsewhere. And so again, I think that is the beginning, and we've been very, we've seen after that a pattern that has developed, that it's not just a place to come and retrieve or raise funds, it is a place to deploy, and it marries up very well with some of these governments in the region, UAE in particular, and saying we want to grow, we want to embark upon new technologies, new growth, and it's a very, I think, just a very favorable time given the storm globally. Absolutely, and Moelis has done a lot here in the region and continues to put a lot of investment in it, which is really great to see. It's a great segue that you've given me towards the second part of this panel and my questions. Clearly, we're here at Investopia. Investopia as a topic is to look at how do you bring more flows back into the country? What do we need to do to attract that? How do you get the likes of the panelists over here to spend more time and effort in investing in our region and in particular in our country? So Bob, I'll not to put you on the spot here, but I quote Ray Dalio recently said that the Gulf states look very, very, in quotation, very, very attractive amid a turbulent global environment. And he in particular sees that this part of the world holds a lot of promise for investors, and specifically called the UAE a renaissance state. With that as a backdrop, how much has Bridgewater done over here, and what would it take to bring more of Bridgewater's multitude of billions to invest in this part of the world?
Well, that's true, what he said. This is a growth market. Part of what's happening that's so fascinating and powerful is the synergies across economies and countries. And there's like a new model of how to grow an economy, which is being applied here in the Emirates, but also in a number of other countries around the Gulf, which is the idea of a strategic plan for the economy and the country from an economic standpoint. I would think Singapore is a great model for what they've done, right? And absolutely. Singapore basically runs that country like a company, and they have a strategic plan, and it's all coordinated, and they identify their strategic advantages, and so on and so forth. And and that's what's happening here, right? And so that combined with the capital available, combined with the kind of a generational shift, is really producing a tremendous vibrancy and energy that creates opportunities for growth, but also creates gaps because you have growth rates of different degrees in different types of industries, and so those gaps are ultimately the needs that need to be filled.
Great, thank you for that. Steve, if I can just turn over to you. You know, when we spoke a little bit earlier, we're talking about how Wafra has done a lot of things that are quite differentiated. So recently, you've done a $1 billion partnership with the Swedish fund for co-investing. You also are quite a contrarian in the sense that you fund a lot first-time funds, and you've spent a lot of energy behind advocating for first-time funds. Do you see yourselves doing similar type of things in this region as well? Having, institutional, if you want, co-institutional relationships, which brings you back to investing here, as well as helping these funds over here that are looking for raising capital as well?
I had I'll mention this contextual point. I've had the experience now of working for two sovereign entities. I now work for WAFRA, which is owned by the Social Security System of Kuwait. And for 10 years before joining WAFRA, about a year and a half ago, I worked at the Alaska Permanent Fund, where I helped launch an alternatives program. The Alaska Permanent Fund's a roughly $75 billion fund based up in Alaska, which you probably all know is in the upper left-hand corner of North America, and almost literally off the map, truly off some of the maps that I've seen here. My experience there in Alaska was a positive one from start to finish, but there was a point of frustration. Something that bothered everybody there was that we would typically have managers, public, private, and everybody else, come and visit us, ask for money, and then leave. Often they'd leave, come back 3 years later, ask for more money, and that was happening here in GCC countries, 20 years ago, and it's still happening in Alaska. What's changed is that there are really compelling economic opportunities now in the region, and we recognize that. Our approach to that at WAFRA has been, and this isn't only because of the frustration I had in Alaska, it's a shared perspective across the firm, but the approach is, I think, differentiated in that we're focused truly on partnership. And I'm well aware that partnership is probably the most overused word certainly in private markets, maybe in asset management, but true partnerships can have intrinsic value for all parties. And what we've tried to do at WAFRA that I think is differentiating is we've identified areas where there's value in the teaming. That is to say, there's fundamental value in joining hands, metaphorically, between institutional investors. An example of that, two examples you mentioned, May, are co-investments and seeding strategy. In the case of co-investments, our parent committed $500 million, and AP3 in Sweden committed $500 million, which is a really enormous commitment for them to improve the quality and the quantity of their deal flow and increase their ability to execute on co-investments. And similarly, in seeding, we recognized in Alaska and worked with WAFRA to help form a seeding entity that ultimately is managed by WAFRA, but owned by 4 pension funds. So each of these institutions derives a benefit from the participation of the others. It means that they can dedicate resources to the strategy, and that they can, with greater confidence, back first-time managers. From the institutional investors' perspective, doing this through a vehicle that we call the platform Capital Constellation, doing it through a vehicle like that allows concentrated resources to do the work that's required to offset what's probably slightly higher intrinsic risk in first-time funds. So we love that these new managers exist. We think that that really, to the extent there is innovation in private markets, it occurs among these emerging managers, these first-time funds, agile funds. We want to capture the alpha that exists in those first-time funds. It would be terrible to do it, though, assume the risk and not get paid for it. So we designed this program, and a programmatic approach to first-time funds has value that I think would have been impossible to capture had we not teamed up. That's the reason we're actively working with partners in the region here. We think that there's deal flow, there's opportunity that we can capture only with a presence here in the Gulf. So our form of interaction here will be kind of a peer-to-peer, shoulder-to-shoulder approach to markets where there's value and standing shoulder to shoulder with sophisticated investors like Badala.
Thank you, Steve, for that. Marlene, we spoke earlier. This is your first visit
Yes.
to the UAE, and hopefully not your last.
Indeed.
You mentioned how much IMCO is going towards more international investments now, going into into Japan, into India. Are you coming here? Can we see you investing more in this part of the world?
Well, this is our second time at Investopia. Our CEO was here last year, and so we're certainly establishing relationships in the region and very excited about doing that. There's relationships both directions. You know, we're both energy-based economies. To start, Alberta is built on the energy sector. And at AIMCO, one of the things that we are doing is working on a specific strategy around energy transition. And that's a new $1 billion allocation of capital that we've gathered from our clients as well. And so we expect that we'll have some partnerships related to entities here who are interested in the same space. Infrastructure is the area that we are most globally diversified, and I've had some interesting conversations this week with potential partners as well around infrastructure in this region. So I think there's plenty of opportunity, and we do have a foothold here in the public markets. We do have a foothold here through strategic partnerships, through, you know, for example, with Brookfield, who's here,
absolutely.
and very big presence. So we're establishing a footprint, and it's small steps at the moment, but certainly an exciting area.
Well, we definitely look forward to seeing more of you here. We have a little bit of time. I have two questions, and Eric, I'm going to keep you till the end because I think it's interesting to get your perspective. But Bob, question for you: what's next for Bridgewater? Are you staying in public equities? Would you look at diversifying into private as well? Are you looking at credit? Where do you see the next wave of where Bridgewater takes us?
I think we need to move into more of an asset investing realm. You know, we've proclaimed we're going to limit what we do in pure alpha and maintain that kind of that flagship at a smaller size, and not really seek to grow through that. But you know, in order to then continue to grow and serve our clients in new ways, extending our capabilities into asset markets.
Right.
You know, the pure alpha has always been structured in such a way that we didn't want to have a long bias. You know, so if you don't want to have a long bias, you can't hold assets. But that leaves up tremendous opportunity to apply what we do into the asset markets. And that could be infrastructure, insurance, banking, real estate, you know, in the Middle East for sure. And so those would be, you know, that's all, you know, under consideration right now.
Great. I'm going to end with you, Eric. I know they're now telling us we have to wrap up sooner, but I can't help but ask the question, given your background. Elections in the U.S., is Trump coming back? And what does that mean for the world?
Look, I would just say, May, don't have a crystal ball, but I will tell you, it is, as you know, our country is extremely polarized. You mentioned earlier. I believe it's a result of sort of a transition that we're going through because the old sort of governing economic policy consensus that we had been rallied around, and I call it like the Reagan-Clinton consensus, is now something that has sort of eroded. And our country does this every 35 to 40 years, ever since 1867 and the end of the Civil War. You can mark it and see that we've transitioned. And we're in that process. And it takes leaders, it takes thought leaders in academia, it takes economic events that spur these things into happening. And I think what had happened is the great financial crisis and the aftermath, the Great Recession, spurred this sort of end of the old consensus. Donald Trump comes in, personified sort of now, here we go, and it's a very choppy period of time when you're in transition. So it'll be a really close election. I can pretty much assure you we'll get some amount of instability. We've seen that in our country. But ultimately, the institutions upon which my country's built will stand. I am confident about that. I think that the U.S. can still be counted on to be that birthplace of innovation, of dynamism, of economic growth, and ultimately will reassume a more certain, I think, geopolitical leadership.
Amen. Well, thank you very much for that. And we're all closely watching. Bob, Steve, Marlene, and Eric, thank you so much for your invaluable insights today. I hope the panel answered a few questions and sort of talked a little bit of the insights of what our panelists were able to give us, and hopefully we continue to navigate in this uncertain world towards a better future. Thank you very much for your time.
Thank you.
Thank you.